Hey, welcome back. It is May 2nd, non-farm payroll day. Jobs came in better than expected. Revisions were down. Unemployment rate stayed at 4.2%. Average hourly earnings were down. Market decided, hey, let's go up again. So everything's still in the green. I just, this is my thumbnail for the day, technical resistance. Are we going to see, it's obviously, from the bottoms on April 7th, it looks like, is this a V bottom? You look at the DAX, you look at the FTSE, you look at some of the related indexes over the world. A lot of things that broke in April are right back up where they started. The U.S. is not. Obviously, the U.S. had that little rotation into February, pulled back into March, dropped hard into April. We have now pulled back into the same space. So we're right around these same levels that we were with the pullback in March. Now, my question is: are we going here? Are we going here? Are we going nowhere? I think right now this little reflexive melt up has been pretty impressive. It's been nice to de-risk, deleverage, as I've been talking about for the last several weeks. I've been able to do just that. I am now up to about 60% of my account is in cash. I am near, not to them, but I'm near the watermark highs for the year, which is around 205. I did take some losses along the dump. It wasn't foolproof, but I'm still happy to be up, 165K for the year. And since last year's election, it's actually probably closer to $300,000. So I'm still hanging in there. I'm happy. I closed out a bunch of winners today. I posted this on my Telegram. So this is a couple things that I will share. So this was my week. Keep calm and trade. You just got to keep trading. For the week, daily profit play service, we went 9 for 9. That feels pretty good. Waterfall, we had 3 winners. We've closed out every open position. We are now, the streak I've got at the bottom, I think it's 77 for 84 trades, all winners. Not too bad. Newsbreakers had 2 winners this week on Meta and Microsoft. Have a couple more trades running for next week. That would include Robinhood and Apple and Amazon. Double Up went 1 for 3, just finished a nice masterclass. So going to overhaul the strategy a little bit for some high reward to risk. Other trades, here we go. Winner on IBIT, winner on Google, winner on SPY. American Express took about a 64% winner. Tesla had a nice little ratio spread. Delta Airlines, I was up around 69% on naked puts. Rather than waiting, this is a leap. I literally put the trade out to like January of next year. But it was because volatility was so high. I'm like, I'm going to take some puts on Delta. And the price bottomed and rip up here with this last melt up. So I was up about 70% max credit on those puts. I'm just taking the profit. Alibaba had some winners, a winner on a credit spread and a naked put. Baidu had a winner on credit spreads. I was like 30 wide on that, took a couple $100. Apple had 3 for 3 with a credit spread, naked put, and a ratio spread. Snap had a synthetic long. I bought a call and sold a put at the same level. Took a nice little couple $100 winner there. Nvidia had a ratio spread, naked put. The Dow credit spread, naked put. Palantir ratio spread, naked put. Chipotle went 4 for 4 on a put combo. I sold a bunch of puts on Chipotle when the price was down. Up around like 75% of max credit with earnings coming next week. I'm just going to take the profit, not worry about it. Took a winner on Dell. Took a winner on SMH for semiconductors. Took a winner on Oracle, which actually was down. I think I had a 155 by 150 ratio spread, and price on Oracle was down to like 130. I was like, fudge, I might be taking an assignment on this one. Didn't get assigned. It came all the way back up to 150 today. The expiration was 5/16, so I was still out 2 weeks. But I was enough to get like 80 or 90 bucks a contract, so I took the profit. HIMS, great trade today on HIMS. Actually closed out for more than the max diagonal spread. So I got a little bit of that profit trap on the diagonal spread, which was pretty sweet. Ended up doing a debit on this one for like $17 and closed it out for $23. So I made a nice little winner there. Or it was like $18 closed out for $23. Nice little winner there. And then a ratio spread on Amazon. So all in all, 45 trades, lots of winners this week, decent amount of cash, sitting in about 55 to 60% cash. I kind of hate it. Obviously, I wish I was like, fudge, I should have been more aggressive during, but it is what it is. This nobody knew the bottom was in. I was comfortable taking a stab at that April bottom. Market breadth was super low. The timing was right there. We had, dumped 15% for the month of April. I mean, literally from April's like open volatility up and down. It's been a crazy month. And here we are, May 2nd. It's like, yeah, we're still just melting up higher. But that's the impressive power of the market. So long story short is I don't know how this market just keeps justifying higher levels. Here's my biggest concern. Okay, Sam, welcome back. I know you're in my last class. Here's my biggest concern. I talked about this morning. Let me go into this chart here for the Fed funds rate. Oops, there it is. Fed funds rate. All right. This is probably my biggest concern going into the rest of the year. I know the Fed is supposed to be cutting rates. I know that Donald Trump is being very vocal about telling the Fed to cut rates. The problem that I see is over the last 25 years, every time we've seen meaningful cut cycles by the Fed, the stock market has performed very poorly. And I know that it might be different this time, but why would it be? Okay. I don't know. I mean, there's still, I know this little relief rally feels good. It should get cheap people, out of trouble. I'm as cautiously, I'm just cautious. I'm not even cautiously bullish. I'm just cautious. I want to be positioned for. I don't know how bullish I'm going to be at this point. I mean, I'm literally sitting in 60% cash for a reason. I want to deploy it, but I don't see tons of good opportunities. If this market's going to have, I mentioned in the screenshot here, if this is a V pattern versus the W pattern, that's a very different way that we trade these markets, right? A V pattern would be this. We had the big flush down into April. The market is here, okay? If this is a V pattern, then maybe it goes sideways and then goes higher. And that's a V bottom, and that's a little cup and handle pattern that might persist. That could be head and shoulders. But if this is a W, that means that we come back down and retest and possibly even go lower, come back up, come back down, and then go. And there's still a head and shoulders pattern here, but the bottom is not necessarily in, right? So that's the wild and crazy unknown of like, I don't know if we're going to revisit the lows. We could also break the lows and, fake out. I think this is a great environment for like a bear trap around 4,800. I just don't know, like, what is the reason this market would turn so hard now, right? I mean, like Trump and co are very quiet on the tariff side. Feasibly, we don't have any real news until, July something with tariffs and the trade war. Unless inflation data comes in awful, as we see it print in the month of May, we do have the Fed next week. And honestly, the Fed might start the process. And perfect example would be the Fed says, we're going to pause, and here's why we're going to pause. And the market hates it, and Trump can blame the Fed. It's like he blamed Biden for the first 100 days in office anyway. Now we can blame the Fed. So I don't know what turns the corner. Okay. But I would not say cautiously bullish. I would say cautious. I would say if I compare this, let me throw on the SPX and throw this on a new pane. And I just want to go back on the monthly chart and just show like it's not always great when the Fed goes into these cutting cycles. So here is an example. If I zoom, see if I can take this indicator down a little bit. All right. It's so small here, but you can still see even in this environment, the Fed started to cut rates. Okay, started to cut rates. And I mean, we did have a downturn. That's not as exact, but you start cutting rates here. Start cutting rates here shortly after market dips hard. You start cutting rates here. This is more in line with like, okay, this is where crap gets bad. This is where everything's like crazy the last 25 years. There. As soon as we start that rate cut cycle, this market's already started to turn over. As soon as we start that rate cut that we start to cut that rates, the rate cycle, we're already down, right? As soon as we started here, you're going to see with COVID, we're down. Like, and it was, obviously it was handled quickly, but cutting rates, emergency style. I mean, there's your move. So we already started last year when the Fed cut 100 basis points. Now, I get it that the market has been making all-time highs and continues to make all-time highs, but look, you can take this crazy trend line all the way from this 2009 low. That's an outer trend line that I wouldn't be surprised at some point that we end up hitting. This is an inner trend line, okay? And right now, even this level is pretty critical that we see this level hold. So just looking at the monthly S&P, I mean, I think we can go higher, but man, if this thing turns over, it can get real ugly really quickly. And I don't, like I said, I don't know what the catalyst is, and it's okay not to know. I think it's crazy for people to think like this is going to happen. I posted this yesterday in Telegram as well. Um, but so we started the cut cycle here last year in September. The market didn't really love it. They were blaming the Fed, saying it was too reactive. It was an overshot. They shouldn't have cut 50 basis points. It was whatever. It was messy, but yet the market still kind of navigated through it. We didn't really have any uh, real move in September. I mean, honestly, like all the drama was happening from mid July to August in 2024. That was when the market started to roll over in mid July. We started to see the labor market softening in mid July. We saw the Japanese yen deleveraging happening over that couple weeks from late July into early August. That was the big event, right? And then all of a sudden the market, bottoms after about a 9 to 10% drop and then rips up. We actually go all the way up through September to get back towards the July highs, and then we proceeded to go higher through the election and had that big Trump bump at the end of the year. So point is, the cut cycle has started. This might be just kind of a prolonged move. So if this is the start of things, I mean, I just think we're on borrowed time. And on top of this, we haven't talked about the old inverted yield curve. We went from an inverted 10 and 2 year and inverted 10 and 3 month to disinverted on both. Every single time the 10-year 3 month has been inverted to disinverted, there's been a recession within about 16 to 24 months. And sometimes recessions have stock prices go lower, sometimes recessions have stock prices go higher. I don't know. Um, but I just think this is crazy to think like this market is going to be crazy bullish, right? Fed says, Jim says, I thought the Fed cut rates to juice the economy. Why would that cause? Because usually when they're cutting, Jim, they're cutting into weakness. The reason the Fed starts to justify cuts is because things are getting weaker and things are slowing down. They're trying to stimulate, which is why they're cutting. So, I mean, it's like they're kind of greasing the wheels here, but oftentimes when they go into like these aggressive cut cycles, it's usually doing it in weakness. So I'm just comparing the charts, right? Like you can see like this cycle, this cycle, this cycle, this cycle all led to downturns in the market. And again, maybe it's different now, but I don't know. I don't know why it would be. I mean, you can stack up, and this is the weird thing. What else has been going on that there's all sorts of pros and cons. Like this is seriously like the most, like, I'm just gonna say interesting for lack of a better word, but nobody knows what's gonna happen. Nobody, right? And here's a good example. You've got some very smart people that have put together this right here. This is the widest gap in the S&P targets since 2000, right? Meaning like what's the upside target, what's the downside target, the left tail, the right tail. It is so big and wide that basically this means nobody knows where things are going to go. Okay, which is why this market has been melting up, because sentiment was so crappy and so extreme and so bearish, and it is still bearish. Look at this. Look at this right here. I posted this in my Discord or my Telegram today. AAII Investor Sentiment Survey. This is now 10 weeks in a row. This survey started back in 1987, nearly 40 years ago, and this is the most bearish it has ever been. Okay, so I just have some thoughts on this. Let me just like talk out loud. I think if the bears start to change their tune, I think if these perma bear investors from these sentiment surveys start to change their tune, and they start to come off of this bear sentiment and start to flip, and all of a sudden the pain trade is you're squeezing all the bears right now. You're squeezing all the bears right now. And they hate it. So what are they doing is they're closing out their shorts, and they're possibly flipping long, or they're going to cash. Okay? But this squeeze happening is going to potentially make them switch their tune. I mean, 10 weeks in a row is a lot. That's never happened before in nearly 40 years. So if it keeps printing over 50%, this market might climb that damn wall of worry all the way to the all-time highs again. But I don't know how much higher we necessarily go. I mean, I'll look at it, I'll measure it. I'm not going to fight it without having something a little bit more obvious. But I don't know. I mean, the crappy part is I will say this: it's going to be challenging for me to justify deploying capital at all-time highs. It will be very difficult for me to say I'm not going to be excited about putting on fresh trades at all-time highs unless I'm going to put on trades that literally have upside takeaways and downside protection. Some of my best positions right now might be just buy shares and sell freaking calls every week and just generate income, income, income. And that might be the easiest trade for 2025 because as far as the index goes, it could be look with this type of move here and this previous level, we could be setting ourselves up for some type of wild and crazy roller coaster of volatility, which means maybe we come all the way up to the highs again, we break these levels, everyone gets all excited, all the bears have been squeezed out, everyone's now returning to be, oh my god, we broke out them highs, momentum, all the side money comes back in and pumps into these highs. Momentum begets momentum, I get it, but man, talk about an ultimate bear bull trap right here. If we top out, I mean, I just wouldn't be shocked to see the market do this. What's nuts about this, and this is totally hypothetical, this would ruin so much confidence in the stock market. To see this market drop and feel like people got faked out for this correction, ride this thing through these highs again, and then get faked out at the tops to come all the way back down to make a lower low, and then make a lower low, then make a lower low, like holy crap. I'm just throwing out a potential example of like how wild this thing can be. Um, I don't know. And it's like I said, it's okay to not know. But I also think that the best trades, I mean, right now it's like I hate to say it, but my gosh, I might just allocate more money to Tesla, sell covered calls, and try to make like $200 to $300 a week. Easy, And if it goes higher, awesome. I'll just keep selling calls. I don't even care that I'm not even at price. I don't care. I'm just going to do something to generate income, right? But this index to me is it's been head spinning volatility. I think if we are lucky, this market continues to go higher and we'd be very lucky. Okay. Especially if it's this like low volume melt up, like it's just every single day. Last couple of weeks, like what's happening every single day. Look at this since we had a fake out on Wednesday, but the last what is this, 3 out of 4 weeks? So after your April 7 bottom, okay, your April 9 crazy day heard around the world, we had a quick pullback, we bottomed out, and there was your low to high swing, match the levels here. I mean, all these like technically were actually pretty darn good. I called a lot of this stuff, which I was pretty happy with, like that bottom there. And then it was, gap higher, gap higher. This was a fake out, fake out to the downside. It was just a buy and dip on Monday. And then we came back, or that was actually Wednesday this week. This is the Monday trade. Where the hell is that Monday trade? This was Monday. That was that stupid Monday trade. But gap up, and then a gap up today, or from Wednesday to Thursday, and we came back to fill this gap. Okay. So for this melt up to continue, again, just connect the lows. There you go. Does anything happen in here? I mean, this gives the market now time. If we start to falter, if we start to chop around, a choppy market in this environment here could make some sense, right? I mean, wouldn't it make some sense to the market is like, okay, look, we kind of broke the market for the first 3 months of the year. You go into early April, you essentially broke the market. All right. Now the market's kind of getting its footing back. It's trying to get some traction back. It's trying to make some sense of reality. It's been slapped around a bunch and its head spinning. Now the market goes sideways. Let's say it goes sideways up here. This would be where the bigger positioning would have to take place. Are we going to break down or are we going to break up? But I don't think it all just happens in one straight line. If we just keep melting up higher, pleasant surprise, but I'm not planning for that. And I don't think we immediately turn on a dime to go back down. Right? Make sense? So, charts do not say sentiments. Yeah, I get it. I'm just saying that this is the wall of worry, right? I mean, look, when sentiment was so bearish, that's why I was long. It's a great contrarian indicator. So yeah, it's nice to be long. I mean, the sentiment, yeah, they're wrong. They're clearly wrong. But what it shows is that everyone is still really cautious. And there's no volume in this rally. Like this rally is thin. It is led by Mag 7 recovery. It is not led by the broader market. We still have about 65% of all stocks right now down below a 200 moving average. That 200 moving average is going to be an incredibly important spot to see how many stocks get back above that. because if it's still a majority that stay below it, we're still in a sell zone according to market breadth, you know. But yeah, it's been a nice recovery. The nice thing about the market is that it's pretty reflexive. Okay, nice, Jim. That's awesome, dude. Okay, so point is, a lot of direction, right? You think about how this market's behaved in 2025, a lot of direction. We basically, chopped around at the all-time highs here before we started to roll over. Let me change this to a slightly higher time frame. There. So we had a couple weeks of chop here right at the all-time highs, and then the market broke down. So it's break, 2-week retest, dump, market breaks, Trump pauses, pulls back, lots of volatility, and then it's been in melt up ever since. And the melt up is getting us right back to where this whole nonsense started. Okay. So is the market going to calm down for a little bit of a breath? And now we have, okay, Fed doesn't do anything next week. Fed apparently doesn't do anything in June either. I was really surprised to see the watch tool change. The probability is now looking at a July cut, not June, which timing wise makes a lot of sense because what happens if this trade war stuff escalates in some capacity and the Fed has to maybe step in? And I mean, and this is maybe what happens. Maybe the trade war gets better and the market rips. I mean, I don't think there's any reason to think we can't go to all-time highs if this China-US trade war is resolved. I mean, this is what the market's been waiting for. The market's already recovered, pretty much the entire break. This was the nasty spill. This is Liberation Day, right? And post-Liberation Day, the market's recovered. Okay, so all the tariff shakeout and fake out has been recovered. Now the market's going to potentially justify, like, can we go higher from here? Well, I would say US China resolution looks like we can go to all-time highs. I will deploy some capital. Okay. Realistically, I'll probably buy shares of SPY and probably throw on some collar trades. Um, I might trade something I might trade something cheaper. I might do like synthetic on a Schwab ETF and trade it synthetically where it's like I can get it and get the same type of reward to risk. But hopefully it's, just percentage gains. Just because I don't want to tie up, $5,700 or $57,000 on owning 100 shares per account, right? But I mean, China US, let's say China US, China and US resolution. Okay, I could get around that. I can say, yeah, the market would be still waiting and wondering, can this be resolved? Can this be a win-win? If so, boom. There's your rift to all-time highs and probably higher, in all honesty. And why would it be higher? Because it wouldn't just be US fiscal spending that started to sneak up, last fall. I mean, China has backstopped the property markets. They've backstopped their stock market. They are doing fiscal policy. They are spending money. Eurozone is doing fiscal policy. They're spending money. This repatriation of things leaving US going to non-US. Germany's doing really well in the DAX. FTSE's doing really well. They've almost fully recovered. You've got even ETFs in like Latin America and Brazil doing really well. Everything in Europe is doing really well. China US is kind of right there. I could see this having some real force to the upside. Okay. But without China US resolution, I think the US economy is slowing, right? I don't think there's anything denying that. What is happening? We have layoffs in the economy, right? If we look at, I'm going to watch, continuing jobless claims. So continuing jobless claims and initial jobless claims. I need to watch those. Unemployment rate, and that's the slow burn. Like by the time these start to tick up and trend, the prices could already be in, the market could already be turning over, and all of a sudden we're in recession. But prices might reflect that at either they lead the way or they lag. I don't know. That's a 50-50. But the US is probably slowing. I mean, Apple's a good example. Apple's probably one of the Mag 7 stocks that's the most exposed. Microsoft seems better positioned. Meta seems better positioned. Amazon seems better positioned. Amazon got a bunch of trouble this week for potentially putting tariffs on their checkout page. I don't even, is that real? Did anybody see that on Amazon? If you actually put something in your cart and it said, Amazon price, tariffs, and this is the total, I don't even think that was real. Maybe it was. But according to what I read in financial newsletters, it was, they called it hostile and whatever, but I guess that was all resolved. So, this is why the targets are so wide. Are we going up or going down? Nobody freaking knows. Okay. But this is going to be, if not sooner, this is July, is China just going to stay quiet? Is the U.S. going to try to jawbone it and say, like, we're talking to China, things are going well, we want to work with China? That's all we've been hearing. But we don't actually know that things are happening. Okay. Um, the one thing China needs from the U.S. is they need us to buy stuff. The one thing we need from them is we need resources, natural resources, refined resources. They do it very well. The shipping containers they have with like raw materials and refined materials, they have most of that compared to us. And it's a big if. Like, can we get a piece of that? I mean, I don't know. But if there's not resolution sooner than July, it's like, what happens in July? Your guess is as good as mine, right? And on top of that, you sprinkle in, okay, May with the Fed, right? FOMC, May is supposed to be a pause. Now I'm seeing that June is going to be a pause. And then July is looking for the cut one. That's cut one. So let's go to the watch tool. Here's the CME watch tool. And let's go to probabilities. Right now, and this has gone up even more. So next week, heading into the Fed meeting, there's a 99.5% chance that price doesn't even happen to do anything. It's going to be the same 4.25, 4.5 rate. And then June, this is a 63% chance they still maintain a pause. Going into July, this is the end of July, by the way. So they've pushed out the date. Usually it's like the third Wednesday of every month. Now it's July 30th. I don't know why that's the case. Sometimes these dates have gotten interesting, like in the beginning of the month or end of the month. I don't know, but we did see core PCE this week print. It did go down a little bit year over year, but now the pause has been pushed into now a rate cut in July. So July looks like cut one. This is all subject to change, but July and September and again in October look like the 3 cuts for the year. So 3 cuts by the Fed for the year, and then maybe 1 cut in. Looks like really only 1 cut through 2026, which is kind of crazy. Only 1 cut there. So we'll see. And then 2026, end of the year, maybe 2 cuts if you get into the end of the year. But this is all subject to change. There's an argument right now that the Fed doesn't cut at all. Inflation. Yields are sticky. And this is another thing that's just it's a huge question mark in my mind. Okay, look at the bond market today. Look at IEF and SHY. Look at these bond markets. These things have just straight dumped because yields have been going higher. Yields are spiking higher. So, 83 down to 82. It doesn't seem like a lot, like a dollar wise, but percentage wise, that's a pretty big drop in the short-term treasury or the short-term bonds. The 7 to 10 year also dumped. The 20 year stable, but this is where the bond market essentially broke. This is the basis trade that broke over April 7th to the 12th roughly. We're not at fresh lows. I think that maybe scooping up some bond prices here could be good for scalping. I wouldn't mind like scooping up bonds in the near term, but just I don't know. Maybe I need to get in trades and bond futures. Okay, but look at your yields. Take a look at your 2-year yield, straight up for the last 2 days. 10-year yield, straight up for the last 2 days. 20-year yield, straight up for the past 3 days. 30-year yield, straight up for the past 3 days. Sticky, sticky, sticky. Right? Trump is encouraging the Fed to cut rates, bring rates lower. Dude, rates did not behave. Yields did not behave. September, we cut rates, and this did the exact opposite. The last thing that I want to see as a consumer and as somebody watching these markets is I don't want to see the same thing happen again. If we cut rates and the yields go higher, this market is some big trouble because this is the July to December COVID refi pocket that everyone is talking about. This is mostly macro, but this is a big concern on how the heck are we going to fund and refi and finance our debt? Because if you borrowed money at less than 1%, and now you want that runway again, and you got to borrow 5 years out at 5, 6, 7%, that'll break the bank. A lot of companies can't afford to do that. A lot of real estate projects can't afford to do that. Perma financing is brutal right now. Heck, I was literally watching this, point by point, basis points by basis, like BIP to BIP, and I shouldn't even be excited about this, but I think I'm locking in at like a 6.6 for a house in a month, and that freaking sucks, man. But it'd be probably closer to 7 right now. because this thing's up 20 basis points. So, okay. I mean, it'd be 6.8, 6.9. That's even worse. So anyway, and this is why I had this conversation. Like, are we going to see rates come down? I think no, but I think housing prices are going to come down. I think supply is still catching up. I think housing prices that have been sitting here outperforming the market. Let me see if I've got a screenshot here. I know I had it. Let me go to bubble. Nope. I don't know if it's still in here. I hope it is. Let me see if I can get rid of some of these. Get rid of this. Get rid of this. Get rid of this. Get rid of this. Okay. That was a wild fudge. I think that's it. Oh, that was a wild day from Wednesday. End of the month, I had a pretty crazy close. Anyway, I just had those for evidence in case I needed for my cash settle position, but it worked out okay. This trade, close it. All right. Anyway, my point was that the prices of homes have outpaced the S&P 500 since 2008. That is insane. That's not what homes do, right? I mean, yes, real estate is a great investment. You get equity, right? But it shouldn't outpace the S&P. So that's why I think like house prices probably have to come down. If supply side catches up, house prices that homes that have been sitting on the market will sit longer unless you're going to lower the cost or lower the price. So this is all, probably this year to next year. What does the housing market look like? Well, if yields go up and rates go up, then prices are going to have to come down because otherwise we're still in this crazy unaffordable housing market that is going to struggle. And it's not doom and gloom, but because realistically, since COVID, about 60+% of mortgages are all like sub 5. I think even, another chunk of that is like sub 4. I've talked to a lot of people that have like 3.5 or lower mortgages. So in the US at a 30-year fixed, you can sit in those houses and be fine. But that's also like, you can't afford to leave that house. And the worst part is you think your home is worth 2 or 3 times what you paid for it, and it's really not, and all of a sudden prices come down, that's going to also potentially damage some confidence. So anyway, that's where we're at for now. Yields are sticky. I'm surprised this thing has pivoted hard the last couple of days. We're still not below Liberation Day lows. I think that jawboning and saying like we need the Fed to cut, the Fed should cut, the Fed should cut. I don't think they want to. I think if they cut and this reacts the wrong way like it did back in September, this is heading into trouble zone, right? Yields go up to attract more foreign investors. Like we're pulling this out of like an emerging market playbook. None of this is good. So I hope that doesn't happen. I hope if the Fed just holds rates, then this thing will just stay steady. But anything going higher like this could break the market. And it did break the market. I mean, literally the bond market broke on the 20-year yield hitting 5%. That is where this pain trade came in. Like this ridiculous move during Liberation Day, that 20-year yield getting above 5%, like that was what is now kind of like the Trump put. So if these prices start to go back up to that level, I'm curious what happens. And obviously what asset prices do in the interim, I don't know. But all these things are probably too closely correlated, but a lot of volatility can come from it. And it sucks. I mean, I hate sitting here on this, these sessions and saying like, I don't know what's going to happen. But, I think to give myself some credit, I've navigated this pretty well. We talked about getting long in here, selling premium, and it's been a good time to de-risk and deleverage. And you've had now a couple of weeks to do it, right? If you had the courage to get in here during the real mess around April 6th and 7th or 4th, 5th, 6th, 7th, you really took some great advantage of that, which is exciting. But man, I have taken, a lot of profit off of this. I've raised a lot of capital, and now I'm just wondering like when to deploy some more. As I said, could the market go up with some China-US resolution? Sure. And there's probably some momentum behind it. So I wouldn't want to fight that necessarily, right? But how just overall the lesson from 2025 is how stupid and disruptive was that? Very. And almost it seemed like unnecessary. But it just yet again reinforced like if you buy the dip, it pays out. And it does until it doesn't. So anyway, I just think that because there's been so much direction, this to this, to this, to this. I could see this market kind of stalling a little bit, especially May, June, July, until we have more clarity on tariffs. The Fed's not going to do anything until probably July. So what would make the market goose any higher? We already have Mag 7. Some of your biggest market cap companies have already announced earnings, and earnings is okay. It's not super impressive. Buybacks are like crazy low right now. This is a buyback window that potentially opens up the floodgates for like $1 trillion, and we've had a fraction of buybacks. Like I think it's under $100 million in buybacks right now. So that's concerning, right? But hey, price is price. If we go up, enjoy the melt up. If we start to pause, don't be surprised. This is what I'm kind of planning for. And the best way that I'm trading right now is just income trading. Day-to-day income trading, week-to-week income trading, swing trades, they're working just fine. And that's keeping me in the game. The trades that I do have running that are looking good, like I'll keep rolling calls on Tesla for right now. I've taken a good couple of chunks, but MicroStrategy have some shares. Microsoft have some shares. Did a bunch of Google. I did a bunch of ratio spreads on Mag 7 stocks, and they've had a nice recovery. So speaking of that, let's talk Mags for a second. Mag 7. What was the belle of the ball for all these years that probably were 30-40% responsible for every gain the S&P had in the last decade, all of a sudden became like the most hated basket in 2025. But here we are clawing our way back. So is this a resistance level on Mag 7? If so, does it turn over? If Mag 7 turns over, probability is the whole market is going to turn over with it. So, I mean, just be aware, like we're at the equilibrium point. We might pull back into this like 618. We might pull back into this resistance. But again, that could be a great bull trap where the market hits resistance, falls back down, and then breaks the floor and then heads back lower. If things don't get better, we'll probably head back down. I think these lows could be retested. If you look at a chart and see the monthly candle on April, it's crazy what it did. I mean, April is a little tiny red body and this monster wick. And then prices right here. That's current price. So just a 15% drawdown in the same month, and it ended up closing like 1% off the open. To the downside, it was negative 1% for the month of April. Just crazy performance. Let's see if I've got this here. By the way, I'm just going to throw this trade out there. I called this trade this morning. Anybody that's in my double up, I just did the masterclass for it. You're staring at a nice little 2 to 300% winner. I know it's hanging on all the way until the close today, which was not the intention, but still offering up a good chunk of profit. It's almost a 300% profit. But it's also bid, mid, ask is wild and crazy. If I could get 90 cents to $1 for this, I'd be happy. I wouldn't want to let this thing cash settle in the next 16 minutes. So this, after I did that masterclass, I'm probably going to focus a lot on SPY trades because, look at how wide this is. This is the SPX, man. And we're talking about 40 to 60 cents off from the bid, mid, and ask. That's very, very wide. So SPY might be a little bit better, but I mean, SPY prices, if I did a butterfly spread, anywhere between 1 to 3 cents, maybe on the most like 3 to 5 cents. Like that's wide. But anyway, just slightly better positioning. So maybe some SPY trades. Here's what I want to look at for performance. Let's go seasonality, monthly. Let's use S&P. Okay. So on average, the 10-year average is in blue. So on the average month of April, flat for April, and we were flat. Despite it actually being way the hell down here, it was flat. Like April was down here at a peak to trough of negative 21%, and ended up being like, no big deal. April's down 1.15%. Well, what's interesting now is like May and June and July are bullish. Are we going to continue to see this seasonal flow into the markets until, the reality check? The reality check is Fed starts to cut rates, tariffs become a reality again. Do we kick the can down the road? Do we delay another 90 days? Nobody knows. You know, is there a resolution on U.S. and China? Nobody knows. So crazy markets, man. It really is. Are they polarizing? I mean, am I that extreme? Look, man, I'm just trying to make some money. Like, I'm just trying to give a lot of scenarios simply because I want to be prepared. Like, my whole idea is I have to be prepared for what's happening, and it's hard. It's hard to be prepared for a black swan event. It's not, I mean, no, if everyone sees it coming, that's the problem. Like right now, everybody's so bearish. Sentiment is so bearish. This is the pain trade. It's like, so if you think like that, it's like, where's the most pain in the market? Well, the most pain in the market right now is the highs, right? The most pain in the market is everyone is so scared and so nervous that this market just keeps going and going and going and going. And this is enough to convince people to come out of the woodworks, get out of their, get their cash out of their mason jars and bury it under their mattresses and say, maybe I'll put money back in the markets again. And I hate that trade. I think that'd be a terrible investment. Timing wise, that's awful, right? Why wouldn't you get it in here when everything's on sale? But because the whole world is ending, so it felt like this was like the systemic risk that the market felt in 2 weeks. But all I'm saying is, could we go up? Yep. Could we go down? Yep. Could we go nowhere? Absolutely. And I'm okay having that as my analysis because what I will do is trade a bunch of options and keep cash at the ready because look, there's better opportunities. Right now, if this is a big question mark, why would I deploy capital right now? I can't be super bearish and I can't be super bullish. I'm just going to keep income trading and keep income trading. And then when the coast is clear, and I think that it was, when the coast is clear, it's okay, fine. I'll deploy some capital. But I just think that, look, I'm happy to see this. The fact that the market overstretched this condition, got back up to the 200 moving average, good. This to me is as good as it gets. Like when I was down here buying this thing, we started to come back up. And you can go back to the last month of this. Any of these live sessions I've talked about, we get back to this level at 5,500, we get back to this 200 moving average. I am de-risking and de-leveraging. Okay. I show my accounts every single day. You can see that I had, $900,000 in buying power. Now I'm at $1.8 million in buying power. I have a lot of cash available now, right? Could I have made more money? Of course. I could have been 10 times more aggressive, but I didn't know how bad this is going to get. I was courageous enough to take some trades. I've had hundreds of winning trades in the last few weeks. It's fine. I traded through it. But it wasn't like I wasn't scarred and beat up a little bit. I mean, I had watermark highs at 205 and it's 167. So I definitely took some losses along the way. But I'd say it's certainly better when the market from the recent highs, market's still down about 7% and I'm up around 12 to 15%. I'm okay with that. you know, And I hope it's better. I hope that if the market, goes up, then all of a sudden by the time we're back up here to 0%, I'm closer to 20%. And if that's the case, then great, because that way this market did go down 21% and I'm still up. And if you didn't buy or add to it, you're basically like, well, I'm break even now. At least the pain trade is done. Well, now what do? Do you want to keep dollar cost averaging into it? So I'm just saying, like, look at the chart, right? This chart tells me all of the reasons to be a little bit skeptical this market is continuing to go higher. It doesn't mean I'm going to go short. It just means I want to be protecting what I said was the de-risking zone. This is giving you a huge opportunity to get out of trouble. That's all this really is. So get out of trouble, take less risk, and be prepared for something else to happen, right? If we get a bullish pattern, I'll do my best to spot it. I talked about this scenario. We get into something like this where it chops around. It's a big neckline. Can the market break and go higher? Does the market break and go lower? I mean, we could have a head and shoulders that fails. We could have a head and shoulders that's the V bottom. Does it come all the way back down to lows again for a double bottom? Well, if that's the case, I'd trade the crap out of that thing. Define risk down here, but be long the entire way. It's like, that's a great pattern. Okay. But I don't know if I'm going to get it. If I do, guess what? I'll throw 10 situations at the wall and I'm going to remember one of them. As it plays out, I'll figure out like, yeah, I talked about this. So, I mean, this is what it feels like. I'm moving a lot of chess pieces, but I'm going to be prepared for it some way, shape, or form. I'm hoping, and just have a couple of go-to trades to make sure you can take advantage of it. But this is not the time that I'm not risk on, man. Like this was risk on with some courage. This is now risk off. Like, I'm not selling. I'm just saying, like, all the risk I was taking down here has paid me. I'm now taking those profits off the table. I cleared a lot of trades at 55% winners. I cleared a lot of trades at 75% winners. I cleared a lot of trades at 90 plus percent winners. So because I sell a lot of premium, like max credit, max credit, max credit, I'm taking it, taking the profit, and getting out of here. Because all it takes is that move, one little move down, that 55% winner is now only for 25%. That 75% winner is now down for 45%. That 90% winner is now down for like 60%. I give back a lot of profit that way. So I'm not going to give the market a chance to pull back against me, because the only thing that's left is like time. Well, if I want to wait, another 30 days, I can make another, 50 cents on the dollar. All right. Is that worth it? Well, not if we have a downturn, you know? So I'm just going to take the profit. All right. And we're getting some chop here right around that 56.90 handle. Fun stuff. Any other questions? That's a good point. Pim saying, I listened to a podcast yesterday where they said these could be the most hated all-time highs. I would agree. I almost think like you get all-time highs with a level of disgust, because why did this happen? Why did this happen? If we had all-time highs, it is kind of disgusting, because this was almost like a game, you know, and it was heavily manipulated. It really was, because breaking the market with trying to be, big bad US and we're going to tariff the world, it's like nobody effing knew what to do. This was putting global trade on complete halt and freezing everything and changing everything. And this was what looked to be a systemic risk. And then gold surged like crazy and Bitcoin's come out of its shell and the US can't freaking do an auction and the bond market breaks. It's like, that's insane. And I think at the end of the day, all this did is it made the US a little bit less credible. That's what it did. In my opinion, I think worldwide, like, this made the US a little bit less credible, because we completely like showed our hands. Like, this was a break and we reacted to it, but this didn't need to happen. And I don't know if the US necessarily comes out better for it. Maybe it does, maybe it doesn't. But I think that we are no longer like the world security, the World Bank. It's like, yeah, we have the world reserve status, but I do think there are a lot of forces that are moving to change that. This is Ray Dalio's entire campaign for the last several years: changing the world order. China's not going away. You know, I mean, I don't know how much of the world wants to get behind China, but they're not going away. And they have absolute power. They are autocratic. If they have an agenda, they will spend the next 5 to 10 years or longer achieving their goals. The US doesn't have that luxury. The US is a 2 and 4 year political window. So everything that we do now, I mean, if this is so disruptive, Trump loses the midterm elections, then what happens? He's a lame duck president that does nothing for the next 2 years, and this market's the same crap it's always been, with a giant disruption and a huge asterisk on 2025 because of such a stupid decision. That's how quick the pendulum can swing. But I don't know. So yeah, that's what I'm saying. Like, it was unnecessary, and I think the U.S. lost a lot of credibility in the result. I just don't know how ugly it gets. Like, how angry is the world to then truly move away from the US? Because I don't think that's going to be easy. I really don't. But it can be an effort. You repatriate funds coming in, fiscal spending to go to your own country, build your own infrastructure, become more isolated, more nationalistic. That's everything that's been happening. Like, that's been Trump. Trump 1.0 was nationalistic. Trump 2.0 is that on crack. It's been as bad. It's been that bad. So anyway, we will see. But all I know is, as a wrap up today's final hour, it's been a crazy week. I've been fortunate to grab a lot of profit. I'm near my watermark highs for the year. I'm actually going to look at some numbers this weekend, because I'm probably going to invoice some clients. It's been a nice run. I didn't take any invoicing through the election last year. I did one invoice in like October, and going through like November, December, even to this year, it's like I've got another probably $100,000+ in profit. So I'm going to take a look at the numbers. I think because I'm at like 60% cash, I'm kind of sidelined with, like, I don't really like anything right now to deploy other than staying in current positions, generating income, and not taking any crazy risk. So it's to me, it's about as good a spot as any to, see these nice balances. We get a lot of cash to deploy, and anyway, and then it's like Phase two, I'll once I invoice, it's like, okay, clean slate, let's grind again, and I'm just going to keep crunching these numbers. So massive adjustment to, I mean, massive adjustment to what? Moving away from the U.S. I don't know. I mean, I guess your story it would be told by this: if gold is going to, $5, $6, $7,000 an ounce, that's the world moving away from the U.S. If Bitcoin is up to fresh highs, I mean, I don't think it'd be that difficult to really see, like, okay, man, the U.S. has changed dynamically. If gold is up to fresh highs and running hot, if Bitcoin's up to fresh highs and running hot, that's a lot of clout taken away from the dollar. That's a lot of reliance on the U.S. markets to be taken out, where countries might be moving heavily into gold. Bitcoin's obviously become super super popular the last couple of years. The U.S. has securitized it. You've got your ETFs and whatnot. I think these are all good things. Like, these are good for diversifiers. These are good for alternatives. But at the same time, it's like, yeah, this could be what is showing the cracks in the fiat system. But the last thing that, I mean, this is where it gets really bad. If people lose confidence in the U.S. economy, it's going to slow down. If people lose confidence in the U.S. stock market, what happens? I mean, let's just say right now, this would be literally, this is consumer choice. If everybody right now that's working in the U.S. BRICS, I mean, I don't know how many countries really want to truly align with China. I really don't. But if you align with gold, or you align with Bitcoin, or you align with your own country, like, nobody has to just jump in line and say we're going to China. Nobody's going to say that. Okay, but BRICS is a very real entity. But you're talking about, like, the more troubled nations in the world that have complete dictatorships. you know, so I don't know how many democratic countries want to align themselves with, like, that's our. I mean, it might be free trade by necessity, free trade because it helps us out. But I mean, it'd be hard to rely on everyone, right? All right. Anyway, um, I was just going to say, if we're seeing, highs in gold, highs in Bitcoin, US market is nothing but chopping sideways. But if every US worker right now that participates in a 401k plan, what if you went to your 401k plan, your 401k custodian, and said, put me in cash? I don't want to I don't want to allocate anything to the stock market right now. If everyone went zero and you went to straight cash, the stock market would feel it, because there's like a forced buy every single month of trillions of dollars on just natural dump it in the market, dollar cost average. That's the most basic 401k plan that, for 20 years in the markets has done really well. But if everyone said, look, I'm so fed up with this, I don't want to be in the US stock market. It's too risky, it's too uncertain. I'd rather be in gold or Bitcoin or whatever. All that's the consumer choice. That I don't know if that's going to happen. But people have that power. I mean, why do you think Tesla became so popular? Because everyone wanted electric cars, and Tesla didn't look like crap. It didn't look like a Prius. So Tesla became this awesome, EV. But now there's competition, and Elon Musk is barely paying attention to everything he does because he's spread so thin. But I still think Tesla's good at what they do. I think it's not just an automaker; it's a disruptor, and it's an energy play, and it's an AI play, and it's a humanoid play, and it's a future trade, right? But I don't know. At the end of the day, there's always going to be opportunity. Just try to exploit it. Best way to survive this is don't take any stupid risk. I mean, what this year will teach us so far is you can see that the market is reflexive. You can see there's ways to manipulate it. You can see why having cash at the ready is important. You can see why having protection on your positions is important. You can see why undefined risk can be very disruptive, and it can be extremely painful. I know too many traders, too many times, that when something like this happens, they get crushed. Okay. Um, I do okay. I don't take a lot of undefined risk. I don't take a lot of big trades. I mean, it's silly that and nobody gets excited about the way that I trade. Nobody, because my trades are all base hits. If I win, it's less than 1%. If I lose, it's less than 1%. I'm just a guy that's going to grind out thousands and thousands of trades. That's my style. And it's probably the reason I've been doing it for 20 plus years, and I've been doing okay. But it's not exciting. I mean, some of my best trades have been boring. Some of my best trades have taken months and months and months to come to fruition. but it works. Um, and and honestly, the most important thing for me is like it's risk management. When I've got money to look after, it's risk management. That is the most important thing. It's like you're nuts to think there's not opportunity in these markets. These markets give so much opportunity. It's endless. Like you're gonna miss so many trades just because there's so much to choose from. But still, there's countless opportunities to say like, yeah, that's a good trade. That's a good trade. But if you blow up something or you let risk get the better of you, it will mess up your entire trading plan. And that's the hard part. Is because it seems like I need to take more risk. It's like, oh, the market's going up. I need to step on the gas a little bit. It's all good until it isn't. I've been warning traders for the last couple of years, especially using leveraged instruments. I cannot believe how many people were trading MTSX, MTS. What the hell was MicroStrategy? Yeah, you got double leveraged MicroStrategy, you got double leveraged Nvidia, you got double, triple leveraged ETFs on the indexes. I'm like, stop. Just the indexes are enough. One underlying asset at a single leverage is enough. Double and triple leverage. I mean, all these things are layered in now where this is what liquidity providers and brokers have to deal with. This is why the volatility is so extreme, is because there's layers upon layers upon layers of leverage in these markets. So and things like this is when leverage goes away. Liquidity goes away and leverage goes away. And those accounts that look, this is a peak to trough of 21%. You go back historically, the average drawdown in the S&P is 13 to 14%. Average drawdown. This is barely over the average drawdown. But think about how many people were down 30, 40, 50, 60% because they're over leveraged. Lots. And it's pretty reckless when you think about it, you know? But that's why you can do whatever you want. You can be reckless and you can take all this risk and you can, step on it and get this whole upside could be fantastic, right? If you're stepping on like a 2 to 3 leverage position here, you could be up like 30 to 40% on a position on the index that has been ripping for the last couple of weeks, as opposed to the recovery is about 15%. But I prefer to have I had about a 4% drawdown as this market was at its bottom. And I'm back up double digits now. It's like I survived. I'm okay. And I wish I would have made more money? Of course. I wish it was, $300,000, $400,000 in profit this year, but I'm not. But I survived this crap. And that at least is my victory. So anyway, all right. It's Friday. Have a good weekend. I'm going to jump into my last class for the day. I'll let you go. Thanks, everybody. Bye.